Have you felt you had a strong opinion on what price may do this week, next week, or even several months from now, but you don't have the time to sit in an outright position for days at a time? Not only that, but you don't want to take the potential risk in an outright position if your idea is wrong. This video is going to cover some basics on options on futures for those looking to manage risk or take a trading opportunity with a fixed cost. What are options on futures? An option on a future gives you the right, but not the obligation, to buy or sell a futures contract at a specific price before expiration. Just like stock options, they come in two types: calls and puts. A call option gives the holder the right to buy a futures contract at a specific price on or before an expiration date. As an example, if you believe crude oil futures will be trading at a price above $70 per barrel 3 months from now, rather than exposing yourself to 3 months of carrying an outright futures position, you could buy a call option at a strike price of $70 with an expiration date around 3 months out. This purchase of a call will have a fixed cost to you, but your risk does not exceed the purchase price, also called premium, plus commissions and fees. If crude oil is trading at, say, $72 per barrel at or ahead of expiration, as the holder of the option, you have the right to buy a CL futures contract at $70. A put option gives the holder the right to sell a futures contract at a specific price on or before the expiration date. In the same example above, if you believe crude oil will be trading below $70 per barrel in about 3 months, you can buy a put at a strike of $70 for roughly 3 months out. If the market is trading at $68 per barrel, for example, at or before your expiration, you have the right to get a short CL futures position from $70. In this same case, your cost would be the premium paid plus any commissions or fees. In either of these situations, if the market is liquid enough, the option holder can also still offset the option ahead of time. What about selling options? An option seller, or someone who sells an option that they didn't previously own, is also called an option writer or grantor. An option seller is contractually obligated to take the opposite futures position if the option buyer exercises their right to the futures position specified in the option. Option sellers collect a premium from writing the option, but also assume potentially unlimited risk in doing so. So why do traders love them? Here are 3 key reasons. Leverage. Options may allow a trader to control a futures position with less capital. As an example, still sticking with crude oil, you might be able to purchase a crude oil put or call for even less than what you would need in margin to trade an outright position. Keep in mind this carries risk should you choose to take on the futures position. You do not want to go on a margin call or enter to a position beyond your buying power. Risk management. Options can also be used to help hedge against price swings. As a very basic example, if you are long a crude oil futures as part of a long-term trade, but are nervous or uncertain about the next few weeks of activity, perhaps due to OPEC or a news event, you may buy crude oil puts at a certain strike as a protection against your long futures position. Flexibility. There are many different option strategies traders employ which can allow them to take advantage of opportunities in trending or sideways markets. We won't have a chance to get into all of these in this video, but to name a few, a long condor may be used in sideways markets, vertical option spreads might be used for directional bias, but to try and limit downside risk, an option straddle may be used by someone who anticipates large moves in the underlying market up or down. Options on futures can be powerful tools, but they come with risk. Always manage your exposure wisely. Want more trading insights? Like, subscribe, and stay tuned for the next video.